Hello friends. The title of this video is not an exaggeration, but let me be very precise about what it really means for your money right now. The government does not send someone to your front door to physically take your retirement savings away from you in the middle of the night. What it does instead is build a complicated set of rules around your 401k and IRA that change constantly and quietly every single year. If you do not understand those rules, anywhere from 25% to nearly half of a withdrawal can go to taxes and penalties instead of your pocket. And in 2026, several of those rules changed in ways that are catching hardworking people completely off guard. All across this country right now. Today I am going through exactly when you lose money, how much you lose, and most importantly, what you can still do to protect every dollar you saved. Before we get into it, subscribe to this channel right now and turn on the bell so you never miss a single one of these important updates going forward. The retirement account rules I cover today are ones that change constantly and that most financial institutions only explain buried deep in the fine print. Subscribe now and let us get into it, because the first mistake we are covering is the single most expensive error people make with their retirement accounts. It happens to people who did everything right for decades and then missed just one rule at the very end, and it costs them thousands of hard-earned dollars. When you put money into a traditional 401k or a traditional IRA, you get a tax break up front because you skip income tax on that contribution. But that tax does not disappear, it is only deferred. And at some point, the IRS requires you to start taking money out and finally paying what you owe. That requirement is called the Required Minimum Distribution, or RMD. And in 2026, the rules depend on the exact year you were born. If you were born between 1951 and 1959, your RMD age is 73, meaning you must start withdrawals the year you turn that age. If you were born in 1960 or later, your RMD age is 75. So you get a couple extra years. But the requirement still absolutely applies to you. The amount you must take each year is calculated based on your account balance and your life expectancy using official IRS tables, and it changes every single year. What happens if you miss your RMD is devastating, because the IRS charges an excise tax penalty of 25% of the amount you should have taken out. On a required distribution of $20,000 that you missed, that penalty alone is $5,000 on top of the income tax you still owe later. The good news is, if you catch the mistake and correct it within 2 years, the penalty drops down to 10%. But the safest approach is to never miss it. Fidelity, Vanguard, and most major brokerages will calculate and automatically distribute your RMD for you if you simply ask them to set that service up in advance. Now here is the trap inside the trap that most people walk directly into and nobody warns them about until it is already far too late to fix easily. When you first become subject to RMDs, you have a choice to take your first one in the calendar year you reach your RMD age, or delay to April 1st of the next year. That April 1st option sounds appealing because you get more time, but here is what it actually means in real dollars when tax season comes around for you. If you delay your first RMD to April 1st, you still must take your second RMD by December 31st of that exact same year, giving you 2 large distributions in 12 months. 2 full RMDs in a single calendar year can push you into a higher tax bracket, increase the taxable portion of your Social Security, and trigger Medicare surcharges. For most people, taking the first RMD in the year it becomes due, rather than delaying it to April, is the simpler, safer, and often much cheaper choice overall. Now, the second big change that hit specifically in 2026 is a major shift in how catch-up contributions work for higher earners saving for retirement. This one caught many people unprepared because it was buried in the Secure 2.0 Act passed in 2022, but only took effect this year in January. In 2026, the standard 401k contribution limit is $24,500, and workers 50 and older can add an extra $8,000. That brings the total to $32,500. But here is the new rule that changes things for anyone earning above a specific income threshold. If you earned more than $150,000 in FICA wages from your employer in 2025, all of your catch-up contributions must now go into a Roth account. You cannot put them into a pre-tax account anymore, which means you pay income tax on those contributions now in the current year instead of deferring them to later. Some people see this as a disadvantage, but others see it as a genuine opportunity because Roth money grows tax-free and is never taxed again when you withdraw it. There is also a special super catch-up window for people between the ages of 60 and 63, where the catch-up limit jumps to $11,250. Combined with the standard limit, that means someone aged 60 to 63 can put up to $35,750 into their 401k this year. If you are between 60 and 63 right now, this is the most powerful savings opportunity available to you, and it drops back down after you turn 64. Now let us talk about the double hit that affects people who take large RMDs, sell real estate, or have any big income event during their retirement years at all. Medicare Part B premiums are not a flat cost for everyone, and if your income exceeds $109,000 as a single filer, you pay extra surcharges called IRMAA. For married couples, that threshold is $218,000, and these surcharges are added on top of the standard monthly Part B premium of $202.90. The IRMAA surcharges range from an additional $81.20 to $487 per person per month, depending on your income bracket. Here is the mechanism that creates the double hit, because Medicare uses your tax return from 2 years ago to calculate what your current year premiums will be. A large RMD you take this year in 2026 raises your 2026 income, which will then directly affect your 2028 Medicare premiums 2 years later. People who understand this plan their distributions carefully, spreading them across years and timing them to stay below IRMAA thresholds whenever it is possible to do so. One of the most underused strategies in retirement tax planning is called a qualified charitable distribution, or QCD, and it can save you thousands of dollars every single year. If you are 70 or older and have a traditional IRA, you can transfer up to $111,000 directly from your IRA to a qualified charity each year. That transfer counts toward your RMD, and critically, it is excluded from your taxable income entirely, meaning you never pay a single dollar of income tax on that money. For a married couple who both have IRAs, that is up to $222,000 that can be distributed tax-free to charity while satisfying both RMD requirements. If you donate to your church, your alma mater, a hospital, or any qualifying nonprofit, this strategy lets your charitable giving and your RMD work together beautifully. Now let us talk about inherited IRAs, because this is the one that surprises families the most, and where the money lost to taxes is often the very largest amount. If you inherit a traditional IRA from someone other than your spouse after December 31, 2019, you are subject to what is called the 10-year rule. You must fully distribute the entire inherited account within 10 years of the original owner's death, and every dollar you take out is taxable income in that year. Most people inherit an IRA and do nothing for several years, then realize in year 8 or 9 that they must withdraw everything that is left in a compressed time frame. A $300,000 inherited IRA forced out in 2 years can easily push a person into the 32 or 37% tax bracket for those years. The tax-efficient approach is to spread the distributions evenly across all 10 years, taking roughly 10% per year so each year's income increase stays manageable and controlled. So here is the full picture and everything we covered today brought together so you can take action and protect the retirement money you spent decades building up. Missing an RMD costs you 25% of the amount you should have taken, reduced to 10% only if you catch and correct it within 2 full years. The 2 RMD year trap is created by delaying your first distribution to April 1st, and for most people, that delay should be avoided to keep your tax bill lower. Starting in 2026, catch-up contributions for earners over $150,000 in prior year FICA wages must go into Roth accounts by law now. The 60 to 63 super catch-up window of $35,750 is available right now, and it will not last forever, so use it while you can. Large distributions generate Medicare IRMAA surcharges 2 years later, so plan your withdrawals carefully with that 2-year lag always in the front of your mind going forward. Qualified charitable distributions of up to $111,000 from a traditional IRA satisfy your RMD with zero income tax if you are 70 or older today. Inherited IRAs must be fully distributed within 10 years, so spread those distributions evenly across every year to avoid a massive and painful tax concentration at the end. The government built these rules over decades, and they are not going away. But knowing them in advance means you keep far more of what you worked so hard to save. Subscribe, share this video with someone you know who has a 401k or IRA, because one single conversation can change someone's financial situation for years to come.